Let's take a look at Aapril's portfolio crowding module. At first, we can see all of the previous analysis that I've run or that my colleagues have run had they chosen to make it firm-wide. Aapril's crowding module is holdings-based, so we actually require the underlying securities within a fund or within a group of funds. Aapryl will have mutual fund holdings and ETF holdings. For SMAs, you can upload a template with the manager's holdings. With smart beta ETFs and quantitative hedge funds, having created an environment where investors are targeting the same stocks due to their factor exposures, we find this can artificially create demand and inflate prices. Once a factor falls out of favor, we could see a rush to exit a trade, leading a lack of liquidity and thus losses. Aapril's crowding module helps to identify these scenarios by rating a fund or portfolio's crowding risk based on the number of factors which are crowded, as seen on this thermometer chart. Here we see the factors which are least and most crowded based on the holdings within the portfolio. We see here there's only one crowded factor within this fund, which puts us in a risk-on scenario. After there are two factors crowded, we get into a cautionary stage, and then we identify severe crowding risk once there are more than 4 crowded factors. We can select which factor we'd like to dig into. Let's take a look at momentum. The first methodology that we use is called pairwise correlation. Here, we're identifying the most exposed stocks to the given factor, momentum, and then measuring how correlated they are to one another. As the red line increases, we see a higher correlation of these stocks, which poses a risk should the factor selected turn and go out of favor. The valuation dispersion methodology also helps to identify crowding. So as demand for certain factor exposures increase, we may see an artificial rise in the valuation of some of the stocks offering such exposure based on price to book. The red line here is showing us the disparity between the value of the least exposed and the most exposed stocks to the given factor, here momentum, within the fund. The risk here is that as the disparity increases, there is an increased risk of mean reversion. The final methodology that we use is fractal dimension. Investors have different time horizons for their trading activities, which impact a stock's volatility. The price of a stock will reflect both short and long-term valuations of a stock. The red line here displays the ratio of short or weekly versus long or quarterly volatility. As the ratio approaches the green line, which is 1.2 ratio, we identify there to be crowding risk. Large spikes can also indicate crowding risk as well. And the final chart that we offer is a factor portfolio showing the value of the basket of factors that we're using within the crowding module. This is Aapril's portfolio crowding module.
For more information, please visit us at www.aapryl.com.